Oh, really?
So now I'm going to have to wait till next year. I really hope that we all have the same seats so I can thank them a year later.
All right. So we got a few little topics to hit here on to wrap up this chapter before our big break. Pretty easy. We're really just dealing kind of with definitions of these non-finance companies. And so last time we wrapped up, what did we hit last year? Oh yeah, Penny Benny is where we left off with. All right, so now we're gonna blow through a few, and then we got to get to our Allison talk, which I thought was a pretty good one with FDIC that kind of tied together some of the different things. Okay, so let's talk about. Your book kind of refers to these as financial facilitators. Again, this is the non-bank area as the focus of the whole chapter. And so this one has almost a misleading name that we've talked about it before, investment banks. They're not really a bank at all, so don't let that throw you. That name just kind of came around and somehow historically, I don't know what the real story is behind it, but the purpose of an investment banker or investment bank is to assist firms in the primary market with issuing securities. These securities could take the form of bonds or stocks. And if it's a stock, it's the initial public offering type of arrangement, the IPO. So what's the distinction between the primary market and the secondary market again?
Primary is initial offering, like it's the first time the stock has been, or whatever security has been issued out, and secondary is just trading after that has been initially offered.
Okay, I'd like a little bit clearer than that. Somebody else other than John want to add to that? What you said isn't wrong, but it wasn't right on. Talk about the flow of funds. Who gets them? Kate, go ahead.
The primary market is where the firm, the company itself, is actually selling them, so it's receiving the funds initially.
Right, and so that's kind of when we think about buying a share of Best Buy, I think the general public often thinks that money might be somehow going to Best Buy. But most of the time, all of that's happening in the secondary market where it's just being traded between two individuals. Best Buy sees nothing of that directly, so that's the secondary market. It's kind of the second time it's traded hands, or second or multiple times, obviously. But and so in the primary market, those firms are receiving those funds, and so that's the important distinction. In order to do that, you have to flow through the government. What agency is particularly interested in this one? SEC, Securities and Exchange Commission. And one of the reasons the company needs a professional that's been blessed by the SEC so that they get all their paperwork in order of accounting standards, reporting standards, what are the terms of the bond, what are the terms of the stock issuing, have they dotted all their I's, crossed all their T's. So, in theory, there could be rules maybe in place. I like to think about, could the private sector handle this without the government? Or how would they do it if they didn't? Well, we could have a rule of law that said you have to fill out these forms the exact same way. And so each individual company that's looking to do this would have to have their own attorneys and their own people prepare the documents such that they could be blessed by the government, or that everybody would be okay, or there'd be some sort of self-policing mechanism. So for a number of reasons, we've gravitated towards the one centralized government agency that is governing that area. All right, so the private sector still plays a role in that. We have these specialists called the investment bank. that does a lot of that, most of that legwork and works one-on-one with the company. All right, any questions there? So, secondary market, we get into brokers and dealers. So, securities brokers, if you're a stockbroker, then you are playing matchmaker. So, you can think of brokers as being matchmaker in the secondary market. They help bring a buyer and a seller together of those financial instruments. Again, whether they're bonds or stocks. If you have the title of broker, then you don't really own anything. So I was a real estate broker, and I helped bring buyers of homes and sellers of homes together. I never owned the home in the meantime, in most cases. There was occasions where I did that, where I tried to flip a house. I bought a house, held on to it, and flipped it, and that made me more of a securities dealer or a real estate dealer. So a dealer holds inventories themselves. And so, of course, that gets into a little bit different of a ball game, where they might be holding on to the stocks and then having a spread off of them. And so brokerage firms can be all three of these. So a brokerage firm can be any combination of all three types. They can wear their investment banking hat. Some of them are just brokers only. Some of them are brokers and dealers to some extent, so they can wear multiple hats. So a brokerage firm deals with that. The firm is not a bank, but we learned from some previous chapters that that's where the line started to be fuzzy, where banks started to want to do some of these activities as well. Banking regulations changed and started to open up banks to being allowed to compete in that arena to some degree. And so that's where the lines start to get blurred and regulation starts to become more difficult too. All right. So we've got the exchanges that they take place on. So the New York Stock Exchange, largest organized exchange in the world. I'm not going to even write it out. Hopefully we all got that down here. New York Stock Exchange, largest in the world. They typically deal with larger firms, tend to be larger firms. It is a little more expensive to be traded on the New York Stock Exchange, so it takes a little bit bigger firm to justify the cost. Although there's lots of large firms that are traded on the NASDAQ as well. So the NASDAQ is kind of the way all the stocks work now almost, but it started off in its infancy as a computer traded program, that there wasn't an open cry forum, that things were done through the automated quotation system, I think is National Association of Securities Dealers Automated Quotations, I think is what that stands for off the top of my head. So that started off and is pretty large. So trading is done by computer system rather than open cry. And there's not too much open crying going on anymore anyway on any of these exchanges as technology evolved. All right, so any questions there so far on any of it?
Kind of going back on the regulation aspect of it, the plastic all aspect that separate kind of the separation from commercial and investment banking, and that's kind of got repealed.
Right.
Do you think that was a good idea? Do you think that?
I don't think it was a good idea. The more I've looked at it, I think if we're going to have a highly regulated industry, then and now that we've seen and known that regulators sometimes don't always do their job appropriately or don't even have the capacity or incentives to do the job right, the more complex we make the organization by blurring the lines between investment banking and regular banking, the more difficult that becomes. And so if we're going to have it be highly regulated, then I think it would be better to be confined to more narrow parameters. That's my general take on it. Mutual funds. So mutual funds are shares of ownership in pools of securities, usually a certain type. So I'm going to keep this definition a little bit loose. Feel free to ask some questions, but we've talked about them a little bit before. So if I buy Vanguard Growth Stock Mutual Fund, I buy $100, I'm a little guy, and I buy one share of Vanguard Growth Stock Mutual Fund. I buy one share. The Vanguard Group has already had an investment money manager that has purchased 200 plus shares of other companies that are U.S. firms that are heavy in equity. Maybe they're large cap funds, so that they're some of the larger companies that are out there. And then Vanguard might sell another product that is small cap funds, but they still might be U.S. companies that are smaller in nature, tend to have a higher expected rate of return, but there's more risk associated with it. They might be more volatile. So that's what I mean by usually of a certain type. You can buy a share of ownership of a pool of companies, but it's not like a random shot at the type of companies. Usually you're kind of picking, and that allows you to diversify your portfolio with certain types of stocks. You're going to immediately get diversified into 200 stocks of a certain type or nature. Okay, any questions on that? Most of these mutual funds are an open-end fund. Open-end fund. So this is most common. And you can redeem shares anytime. You can buy and sell these. There's a lot of flexibility. There's still some funds out there that are closed-end funds. And what they've done is they've fixed the number of shares. The value of this fund is specifically calculated by the performance of the funds that were purchased initially in the fund. So again, this is a little bit of an older animal, so it's not as common. But the idea was, I'm going to buy 250 stocks, and this is what the fund looks like. and then we're going to keep that portfolio the same, and you can buy into it. So it kind of trades like a common stock that way, but its value is derived from the fixed number of shares that are within it. Whereas the open-ended funds, the money managers are all the time looking at the market. They might be buying some, selling some of the portfolio, kind of actively managing the portfolio. Money market mutual funds is kind of a special creature that evolved. Money market mutual funds. You don't want to confuse this with regular old mutual funds. The type of asset that they're investing in is short-term U.S. securities, typically. So U.S. government bonds that are super safe, risk-free, if you will. And because of the nature of what they're putting their money into, they have a special feature to them that you can write checks against them. And it actually acts like a checking account. And so if you want to sell your shares of your mutual fund, you pull out your checkbook and you write out a check. To the point where you can run to Walmart and pay for stuff with your money market mutual fund ownership by just drawing a check. So you'll literally write a check out to Walmart for a $500 television, and you used your money market mutual fund to fund that purchase. And so you might remember from macro class, well, and this class, I guess, well, the class before money banking, our measure of money, M2. So we had currency in circulation, not in the bank's vaults, plus checking accounts, made M1. M2, then we added on savings accounts, certificates of depression, and money market mutual funds. So the Federal Reserve started counting these as money because they're so liquid, and as long as you have a check that's generally accepted at, remember that's our general definition of money, is anything that is generally accepted as a means of payment. As long as they're willing to take that check for stuff at Walmart, then we put it in a measure of money.
More of a personal finance question, Brett. So are you saying that this is essentially a checking account with interest?
Yes, and the drawback is that there's usually limitations on the number of times you can subtract from it. So there might be 3 times a month or something, and they might have a minimum balance of like $25,000. Or there'll be a minimum, it might not even be that high, but there'll typically be a higher minimum balance and a restriction on the number of times you can use it. So it's usually meant to be parked there. It's kind of an alternative to the certificates of depression, but a little more flexibility because you don't have the 10% penalty for cashing them in early. Okay. All right. So I guess I was going to just put on here. So selling shares is equal to writing a check. You don't have to call up your broker. You just pull that little check out of your wallet and go for it. Okay, then we've got hedge funds. Now, what do you guys visualize when you hear the word hedge fund? Anything come to mind when you visualize a hedge fund? I'm just curious what your first impression.
Gossip girl.
Gossip girl? Why? What's true with that?
I just feel like, I don't know, hedge fund makes me think of, like, the really privileged.
Okay.
They have their own separate little.
Okay. So something hoity-toity that the rich, some sort of.
Wasn't Bernie Madoff's Ponzi scheme like disguised as a hedge fund or something like that?
No, because he took on more than 99 investors. So, and that's one of the things with a hedge fund is that there's a max of 99 investors in the hedge fund. And Bernie took everybody's money. Yeah, he was the money manager. So, any other thoughts of hedge fund? What comes to mind? Cadence, what are you just laughing at her comment, or?
It's probably a trust. I'm thinking of a trust.
Of a trust fund, yeah. Well, it's kind of similar. I mean, I get kind of the Wall Street perception of the big fat cat, making trades and big deals, and that's not too far off, really. So typically the minimum investment is $1 million for each one of these 99 investors. Minimum investment. There's been some that were $10 million minimum investment to be a member of this hedge fund. So it's really just a small group of investors that are pooling their money together to do deals and try to make money. The investors are usually the passive. I'm a professional athlete, and I want to park my money somewhere. So I heard this is a good place to put it. All my friends are doing it, and so they park $2 million in a hedge fund, and now they're a member of that. So they're not. My point with picking out the professional athlete is that they're typically not the one actively seeking new investments, right? So there's a managing partner with this, and there's going to be a profit split where it's generally 20% to the managing partner. So, so that'll be kind of, write that down here. So we got a managing partner with 20% cut of the profit, so that's kind of their management fee. Well, actually, there's usually a 2% management fee of the fund, 20% cut of the profit, and a 1 to 2% management fee of the portfolio, which is based on just volume. So that person who's managing that hedge fund is usually a savvy investor. I'm sure the story usually starts off like this, that, hey, they've been doing pretty good in the stock market, they've made millions, and then all of a sudden LeBron James wants a piece of the action because he knew him from his hometown, and so I'll give you $2 million and you do something with my money, right? It just kind of starts off that way, but then it's maxed out at 99. Okay. The reason for the 99 is there is limited regulation. So we haven't really talked about this, and I don't want to spend too much time because we're going to get to the Allison book, but why do we have the government involved in marketplaces? I mean, what is the real purpose of regulation? Yes. What else? Why? Okay, so why aren't they here to provide information to these guys, Colby? Or go ahead and say what you.
Lowers risk. They help lower the risk.
Okay, with the more information out there, that would help to lower risk. But what I think the intent goes deeper. It runs deeper of why, the fundamental reason. That's why I was thinking it'd be kind of interesting to bring this up because I don't think we've talked about it too much. But what is the fundamental reason that we have the government intervening in marketplaces where we've got a voluntary buyer and a voluntary seller, and if they get together and one gets screwed, who cares? Why do we have government regulation?
Probably they don't want people or organizations to become too powerful. They don't want the monopoly.
Okay, that could be part of it, yes. Right? That'd be one reason. If we start to get too much control to one spot, we have a lack of competition, and we know that we want healthy competition in the market. So generally regulation is in place, or the government monitors. The level of involvement will be proportional to the amount of the numbers of the general public that are exposed to the actions of that company. So the more we get the innocent involved, like the depositors at banks, perhaps, right? So the bigger the numbers are, the general public, then the more regulation you'll tend to have. So real estate is kind of a good example of this, where you've got mom and pops, people of all sorts. We want them to be able to buy a home. A home has lots of potential pitfalls. There have been problems over the years with asymmetric information, so providing information certainly is an important role to all this. But the effort was to protect the general public. And so here, regulation's limited because we can look back at this and say, let's not spend government resources trying to protect these guys. If they lose money, they're big boys and girls, they can lose money. We don't care about them, in other words, right? We're going to tax them later on their tax return, but we don't feel like we really need to regulate that because they're not exposing the general public to great harm. All right, questions on that? So that's why it's limited to 99. If this was unlimited, then we might be starting to expose the general public to greater harm. But we feel like if we got it limited, kind of plays back to your question earlier on whether we should allow banks to get into more and more stuff. The more and more stuff they get into, the more the public is exposed to risk.
So if there's like that 100th one, you just go find another hedge fund?
That's right, yeah. Yep. And I think there is some regulation on, the numbers, the managing partner can probably only be associated with one of these firms or something like that, so that you can't have two guys. Of course, there's probably loopholes that you could, get around some laws. There usually is. Private equity funds. These are a growing creature here in the last 20, 30 years. Jeff Hall, an Ottawa alumni, he's come and spoke to us a couple times. He runs a private equity fund. He's kind of this managing partner type person, or one of them, I don't know his exact role within the organization, for a private equity fund. And so these usually come in two types. We've got the capital buyouts. And so this is purchase existing businesses. Possibly public or private. When a private equity fund purchases a currently publicly traded company, they bring them private. So remember, shares are being traded on the secondary market. That large player, usually there's a rich person somewhere behind here, a very wealthy person that wants to mostly invest their money. It could be a small group of people that are getting together to do this, but a lot of times it'll just be one family's wealth. So we might have the Carnegies or somebody like that has a large chunk of money that they're running this company, this private equity fund, and they're just trying to make a buck, like everybody, but their business model is to buy existing businesses that have a decent cash flow already started with them and hopefully make them better. They might be trying to flip the businesses. They might see a business that has good solid assets, but they're mismanaged. And so they feel like they could take them, work with them for 5 years. They usually have a longer term time horizon, and then flip them and turn them, maybe make them go public later, 5 years later after they've brought them in privately. The one that jumped to mind that's doing this right now is Blackboard. Blackboard went private, and they're planning to spin Blackboard, the Blackboard that you guys use. So Ottawa University has had kind of close relationships with them, and so President Eichner has talked to their president and kind of knows that that's part of their overall longer-term business plan with Blackboard. So it could be existing private companies. So they might come to a company in town that's done pretty successfully. Again, maybe it was a family business, Hasty Awards or something, and they come in and say, we'll buy you out. And now that company's going to be underneath the umbrella of companies that are managed by the private equity fund. Okay?
If it is public, what happens to the shares?
They just go away. So they'll basically privatize all the shares. They have to get agreement because it is a voluntary thing. So there might be some final holdouts of, hey, I'm not selling you my share, but at the end of the day, if it comes down to the long-term share price looks like it's $50 and they're offering $60 to buy out all the shares, they usually make it a conditional deal. Like, I won't pay everybody 60 unless everybody's in. Then they have a shareholders meeting and they vote on it, and so they kind of force the issue on the shareholders to agree to sell it all to one place and to let them go. Okay, so that's on the capital buyouts. Mitt Romney, Bain Capital, is one of the biggest companies out there that does that. His firm did that. So on the other side, we've got venture capital. So these are our startup companies. They could, of course, do a little bit of both. They could dabble in both. But the new companies, new ideas, private equity firms will often pick up those companies, so they'll pitch them. If you guys have seen Shark Tank, those aren't necessarily private equity funds. Those guys are just individual investors, but it's the same concept, that they'll go to a private equity fund to raise money, and they might be the majority shareholder with some sort of arrangement with the managers. And then ultimately go public, like Facebook or something. That might be the way to turn a buck. Okay, so that's private equity, and then our last one is government sponsored enterprises. And that's what kind of leads us right into Allison talk today, our GSEs. So we've got Fannie Mae, I'm just going to put two of them up here, and Freddie Mac, FL, usually just don't even put this. So this is Fannie and Freddie. And Allison will talk a lot about this relationship. Government bailouts abound. We kind of swing the pendulum between these being privately run companies versus the government involvement in those markets of subsidizing some sorts of loans. The main impact here in the financial markets is the securitization of mortgages, the mortgage-backed securities that we've talked so much about. That was all a role of government-sponsored enterprise that kind of bundled those things together and helped facilitate that market. Okay. So, let's talk Allison. Okay, so who wants to lead us off?
I guess a lot of the first part of the chapter was basically describing FDIC causes moral hazard. Like we're talking more of an inside perspective of it, more I don't know if I want to call it in depth, but just especially his perspective on it, on what happened with FDIC insurance that caused the banking.
Okay. Who else?
I thought that was most interesting, just over the whole chapter, how he was kind of pointing out that the FDIC insurance policy forced kind of responsible banks to behave irresponsibly because they were losing their business to stupid banks. And even though they're like, oh, you shouldn't do that,
Right.
they're like, well, now we have to, or we're going to go out of business in the short run.
Yeah. Yeah, I think that was an amazing insight. Other thoughts there?
On that,
Uh-huh.
that fact that even talked about how even the stupid banks were causing funding projects that shouldn't even have been funded. Like in long term, it's just building up stuff and we couldn't get paper stuff that we actually need.
Yeah, it was kind of, I love the way he weaves in, and this chapter really hits home for me with being in the real estate industry, and I kind of saw this firsthand how this worked, but it's kind of stupid breeds stupid, right? The deals that wouldn't have got funded because of the aggressiveness of the companies that were able to get in the market due to the setup of the FDIC insurance. So let's pinpoint that first. What's at the heart of the issue with FDIC's relationship to this ability for more risky loans to come out? What was somebody else who hasn't talked yet? I think that's an important thing we need to nail down. So what was FDIC's role? We know that they provide insurance up to $250,000 for all deposits. So what? How does that breed into what's the initial start here of this stupid lending, if we will? I don't think he even used the word stupid. That's kind of our word here.
No, I know.
That's the case there. So what do you think?
Well, the banks, they're taking all of these people's money in, and they're able to offer those higher interest rates because they're in the riskier market. So higher payoff, but also greater potential for
Good.
year.
Yes. So that's really the starting place, is that they're able to get an edge on existing banks. And you guys know how banking relationships are important. How many of you are at the same bank you were since you got your very first account? How many people are still at the same bank they were? So few people, right? Or at least over, looks like most of you, but wasn't there 4? Because 3, 4, okay. So close to half, but with banking, credit cards, other things, and lots of other things, we have these relationships that we built up, and we just tend to kind of stick where we're at. And so if a brand new bank opens up with its shiny new building and new advertising, you know, what attracts us? Well, my lousy bank's only paying 2%, they're paying 2.5%. Might as well give them a try, right? So that wouldn't be there necessarily if we had some risk with our deposit. So that's the part of I thought he did a nice job of bringing up market discipline, which we don't really think about, right? We think about free markets, it's this wild and crazy thing, and it's risky, and it's sometimes fun, but it's dangerous, and so we need the government to monitor it. But he talks a lot in this chapter about market discipline, and one of those goes away when we have FDIC insurance, because when that brand new shiny bank opens up, we might be reluctant to go change from our good stable bank that we're used to, that's always been very conservative and solid and there for us and blah blah blah. With just an increase in interest rate wouldn't be enough. We'd be like, well, what are you doing with my money over there? You'd kind of take a little more cautious eye, or make sure that they're credible in some way, shape, or form.
That happened at my time. We had Bank 10, now Hawthorne, was at one location, and we built a brand new bank, like big shiny, looks like a giant house. It's where I work actually.
Yeah.
But you see a lot of people converting back and forth from Hawthorne to our Citizens Bank because it's more locally owned, and the people that own it live in town, so that kind of was an incentive to come.
Mm-hmm. Yep. Okay. So we get this money in the door. I in my mind, I did a little bit of a graph. I just had to put one up. I don't even think it's that great, but as I was thinking about the issue that he's bringing up with risk, and since you guys are pros now at probability type issues and stuff, I thought, here's the current banking system where we've got the rate on deposits and the rate on loans, and this represents the spread. And in a competitive market, that spread is going to be pretty tight. You know, banks have to watch their costs. They're going to try to make money, but if they make too much money, then there'll be competition, and the other bank will cut their rates, right? So the spread is kind of our fair profit, covering all the operating costs of running a bank and whatever. And so if we have a new bank come in, there's kind of this distribution of what these banks are offering. This is my little bell curve here. And so a new bank probably has to offer some interest rates that are higher on deposits than what we have. But then on the flip side, as he illustrates, that's why I'm not sure this graph is really needed, but on the flip side, in order to cover all your operating costs, that bank has to cover their spread, which is this distance in a competitive market, leaving them with taking on loans at higher interest rates with the higher risk of default people up here, right? So trying to push into that realm. And what might be true is that this is the rate they should have charged. This is the rate that the nice solid bank is charging. They've got a nice rate of 6%. But this bank rejected that one. And so this bank takes them on. And so their effective risk-weighted rate is actually higher, pushing them up into this spectrum, right? So the default risk is a lot higher. It's riskier loans, even if the end rate is pretty competitive. They're not necessarily undercutting the solid bank, but they're in the right ballpark. And they got turned down from every other bank in town anyway, and so they didn't have much of a choice but to go with the brand new shiny sparkly bank.
Whenever you brought up the risk-weighted part, it kind of reminded me of something else you brought up in the chapter. It was on the Basel Accord requirements that we've been talking about, the capital requirement ratios, and it wasn't how they kind of talked about how it wasn't necessarily risk dependent. Like in theory, it was risk dependent, but in practice, it was 4% for housing, 8% for commercial loans, and the housing loans were actually a lot riskier because of
right. They were perceived to be safer, but there might have been more inherent risk that wasn't picked up
because of the subprime mortgage bubble that was happening.
Yes.
At the time,
So in that case, they're kind of pointing out that even the regulators weren't able to pick that up, and he kind of pounds on the regulators in this chapter too, right? On what they're really like, and again, from my firsthand experience, that just kind of makes sense. I mean, it's just human nature. This is back to what is our incentive day in and day out? Who are these regulators? You know, he kind of came out and said that they're not the best and the brightest, perhaps, because they tend to be more rule-oriented, rule-follower type people. They should be, hopefully, very good with details and all of that, but at the same time, they're not. They don't have the freedom to make decisions and other things.
I was thinking I don't have the book with me, but the sentence was like, they're not visionary, out of the box thinkers.
Right. Yeah.
Well, why would you expect them to be?
I'm not sure.
Well, what Allison said on page 50 was the typical government employee earns 25 to 50% more than the comparable private employee, and the argument is that they have more responsibility or whatever, and in his eyes, he wasn't so sure of that they really had true responsibility. Chelsea?
Just kind of like along those lines with regulators and maybe not even just the regulators, but people that still enforce regulation. Like the biggest thing with me was like when just talking about how it's so political, and like the biggest example is like of racial discrimination and things that things we're all accused of. And I just thought it was really
Yeah, that was.
because it caused a tailspin of like everything else that happened after that.
Yes.
From his perspective, like it was what caused then a lot of the issues with the housing market, because there was all these regulations and rules put in place that didn't need to be there to try and solve a problem that wasn't there. And then it just caused.
Yeah.
Well, to be honest, that's just part of it was bad work on whoever was reviewing the paper. Like, I'm assuming that was a peer-reviewed paper. I'm assuming that the Fed doesn't publish papers without peer review.
Yeah.
And that's just, I mean, based on what he was describing, that's just bad math. And the Fed's even admitted that was bad math.
Well,
that?
and like the thing was that like it talked about Bill Clinton, and he just kind of wanted to ensure his constituents and like make sure he held on to them. And so like he was like, there was just I felt like it was almost like not purposeful, but like using the statistics to your advantage, not like correctly. Like the statistics are there, they're better.
Along those lines, he said something about how they would like see something that was wrong, and when the economy was good, they'd ignore it, but then when things start to spiral, then they go after it.
Yes.
So, as a banker, you weren't
swept something under the rug for 2 years or something, he said, and then all of a sudden it's a big deal, and I say, well, I haven't been following this.
Like political party change, you know, you said
Yeah.
all the regulators left, before the party shifted.
Yeah.
Like with that, they weren't at fault for not seeing the failure coming, like because it was bad times. The FDIC needed every single one of the regulators or the whatever they are at that time, so they weren't like put at risk for not seeing the failure coming, so
Right.
they didn't have the incentive to.
John, on your peer-reviewed comment too, the people who are peer reviewing are academics who don't have the first-hand experience that Allison was talking about. So like if that journal would have went out to maybe some practitioners or people like him who are in it, they might have read it and said, you can't just look at the debt-to-income ratio, this is dumb. But instead it goes to somebody at Yale who's never stepped foot into a private business in his life other than to buy a Starbucks. And he looks at it and says, oh yes, all the math seems to be right. They did the derivatives correctly here, and yes, this looks good. Here's a couple critical comments, and I'm serious. That's what we meant by the kind of academic elite that Allison's referred to, is that it really is. It stays in. Often that type of thing would stay in those circles.
Yeah, and I was gonna add, I appreciated his own little story about the BBT because he was saying that when they got accused of the discrimination, he was like, what?
Yeah.
Tell me who?
Yeah.
I'll fire them.
Yeah, and he went down the line.
And then when he was like, well, is there a problem with our system?
Right.
You know, and they were able to prove, no, these that we denied should have been denied.
Right.
Then it was just like, well, what the heck?
And then he held out to the fight, and then it brought us to the political thing that the whole thing got dropped because the administration changed focus anyway, and they just dropped the case. So, yeah, and then but other big banks chose not to fight, like many do. Well, it's cheaper to just pay the fine than to, you know. So, but he held to his principles, and yeah, interesting stuff. A real deep dive into the incentives and things that are in place. So, I will. Why don't you just plan on doing the next couple chapters at a minimum, since it's spring break. I wanted to think a little bit, but for sure the next 2 chapters coming into spring break, and I'll email you otherwise. So, and since the other people are gone, I'll email everybody.
Is that due Friday or is that due?
No, when you come back, you got the test Friday.
I was going to say, please
Yeah.
don't make us do that.
No, you're off the hook. This is after spring break. The next 2.
I know you also get talked about before I came in here, but the econ lab that due on the Sunday.
The Sunday, yeah, it'll be the Sunday after spring break, or whatever, at the end of spring break.
Got it.
Cool.